Hello, astute traders and curious investors. Welcome back to the channel where we demystify the fascinating world of how to borrow stocks and potential short squeezes. Today, we're diving deep into a name that recently popped up on our screener with some truly eye-watering borrow fees, Zhongchao Inc., trading under the ticker ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, who is Zhongchao Inc., ZCMD? This company operates in the healthcare and health information services sector, specifically in the People's Republic of China. ZCMD provides healthcare information, education, and training services to healthcare professionals through its endemic brand. They also have a segment dedicated to the sales of patented drugs. With a microcap market capitalization of just $6.06 million, ZCMD is definitely a small player, but as we're about to see, small can often mean volatile, especially when shorts get involved. Show ZCMD company logo/info on screen. What is cost to borrow and why it matters? At the heart of any potential short squeeze is the cost to borrow, or CTB. This is the annualized fee short sellers pay to borrow shares they then sell, hoping to buy them back later at a lower price. Think of it like interest on a loan, but for stocks. When a stock's cost to borrow surges, it's a huge red flag for short sellers because those fees eat into their potential profits, or worse, accelerate their losses. A CTB fee over 100% means that if you held that short position for a full year, you'd pay more than the stock's current value just in borrowing fees. Why this stock is hard to borrow right now. And this is where ZCMD gets interesting. Our screener identified Zhongchao Inc. with an astonishing annualized cost to borrow fee of 846.6%. Yes, you heard that right, 846.6%. Highlight 846.6%. This isn't just high, it suggests an extreme scarcity of shares available to short. With an estimated float of only 1.1 million shares, even a relatively small amount of short interest can make shares extremely difficult and expensive to borrow. While we don't have current data on the exact number of shares available to borrow or CTB momentum, that 846.6% indicates significant pressure on those who are currently short ZCMD. Our internal composite squeeze score for ZCMD sits at 47.5 out of 100, indicating potential, but certainly not a guarantee of an immediate squeeze. Squeeze mechanics explained. So, what does it mean when a stock like ZCMD is hard to borrow? It means that demand from short sellers to borrow shares vastly outweighs the supply of shares available. When this happens, the borrowing fee skyrockets. Now, if the price of ZCMD stock were to start climbing, perhaps due to positive news, increased buying volume, or just general market momentum, those short sellers paying that insane 846.6% CTB could start feeling immense pressure. As their unrealized losses mount and the borrowing fees continue to accrue, some short sellers might be forced to cover their positions. To cover, they have to buy back the shares they initially sold. This buying action, if large enough and concentrated, can create a powerful feedback loop, driving the price even higher and forcing more shorts to cover, leading to what we call a short squeeze. It's important to remember, though, that a high cost to borrow also implies that short sellers have very strong conviction that the stock will go down, and they are willing to pay a premium to maintain that bet. Dilution risk check. One critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can negate any upward price momentum, even with high borrow fees. For ZCMD, our check found no recent diluted SEC filings, no -1s, -3s, or 424 BS in the last 90 days. This is a positive sign, as it suggests the company isn't immediately looking to issue a flood of new shares that could undermine a squeeze. Recent reverse split watch. Now, something else crucial to ZCMD's current situation, the company executed a 1-for-3 reverse stock split on June 29, 2026. That was just 44 days ago. A reverse split reduces the number of outstanding shares and, in theory, increases the price per share proportionally. This effectively reduces the float and resets the share price higher. Historically, we've observed that many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. While this is a pattern seen in some stocks, especially smaller names, it's absolutely not a guarantee, and many factors can influence post-split performance. ZCMD is currently past that roughly 1 month window, but the reduced flow from the split could still contribute to tighter share availability. Before we continue, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at ZCMD's recent price action. The stock saw a slight dip of 0.93% today and is down the same over the last 5 days. Over the last 30 days, it's down a modest minus 4.46%. Volume-wise, ZCMD traded 1,211,600 shares today, which is significantly lower than its 30-day average volume of over 10 million shares. Its relative volume today stands at only 0.16 its average, indicating very low trading activity. Show ZCMD chart with volume. This tells us that while ZCMD has extremely high bar of fees, it isn't currently seeing the kind of explosive volume or price action indicative of an active squeeze. Instead, it seems to be in a quiet period. For ZCMD, we'd be watching for a significant and sustained increase in daily trading volume, especially on green days, which could signal buying pressure, potentially forcing shorts to begin covering. John Choink, ZCMD presents a fascinating case study with its astronomical 846.6% cost to borrow and a relatively tiny 1.1 million share float, all against the backdrop of a recent reverse split. While its current trading volume is low and price action subdued, these high borrowing fees signal that something is brewing beneath the surface for those short this stock. Always remember that a high cost to borrow is a powerful indicator, but it's just one piece of the puzzle. It takes real buying pressure to turn high borrow fees into a full-blown short squeeze. If you found this deep dive into ZCMD insightful, please hit that like button, subscribe for more unique analyses of hard-to-borrow stocks, and let us know in the comments what other tickers you'd like us to investigate. Thanks for watching, and we'll see you in the next video.